In this video, we're going to talk only about the balance sheet. This is one of the three main documents that any company has to prepare by the end of the year in order to prove and to show the activities they have been doing during all that year. It's very important that you understand all the concepts that are included in the balance sheet and where do they go if you want to understand later the rest of the ratios and the rest of the things we're going to study to learn how is the company doing and if they need to change anything because there's something wrong. The balance sheet provides a lot of useful information for those who are able to read it properly. So this is what I'm going to try to explain in this video. What are the variables that are part of the balance sheet and how you have to place and interpret them in order to read the situation of the company. The balance sheet has two main parts. One on the left that we're going to call assets and one on the right we're going to call liabilities. There are several variables in each part and we will see them one by one in the next slides. But the first thing you need to know is why do we have assets and liabilities? Well, assets are those things that the company has. The company has buildings, has machines, has patents, has brands, has different things. And those things are placed in the assets in the left side. Where does the money to buy those assets come from? It comes from the right side of the balance sheet, from the liabilities. So in the liabilities side, in the right side, you have the money that the company has or is using to buy those assets. This is why total assets has to be the same amount as total liabilities. So when you add all the things you have on the left column, it has to be the same amount than when you add all the things you have on the right column. And this is a very important thing. Little bit later, we will see a little bit about the equilibrium, the balance that you have to have between the assets and the liabilities. But for the moment, just remember, total assets has to be the same amount as total liabilities. Total things that the company has to be the same amount as the total money the company is using to buy them. Let's see now one by one each of these variables, each of these concepts that we have in the balance sheet. In the balance sheet, assets are organized depending on the liquidity. Liquidity means how easy it is to convert that thing into money. So on the bottom, we're going to have the most liquid thing, and this is cash. Cash is already money. It can be in the bank, it can be in the company, but since it's already money, it's already liquid and it has to be on the bottom. So on top we have the opposite, the less liquid thing. What is more difficult to convert into money? It's more difficult to sell. We're also going to separate assets into two different categories. We're going to have non-current assets and current assets. Non-current assets are those that are long-term assets. They are less liquid things. And current assets are short-term assets and show those assets that are easier to convert into money. First thing in asset side, in the non-current assets, is what we call immaterial assets. And this is represented by patents, brands, etc. Things that cannot be touched, usually represented by a document, but they are super important, very important for the company activity. For example, we have BIC, when they started their activity, they bought the patent of the ballpoint pen from an Italian company. And without that, they could not have started the company. They could not have started selling the pens. So it was an essential asset to produce. In the same category, for example, we have the brand name that should be registered and the company should have a document with the brand name. Next goes equipment. And under equipment, we have lands, building, machines, transport elements. These are things that are staying long time in the company and they are easier to convert into money. It's easier to sell a car than selling a patent. So when we're placing these amounts in the balance sheet, these things in the balance sheet, we need to make a correction. This correction is what we call depreciation. Remember, we have already studied. So right under the asset, it goes the accumulated depreciation. So we can see what the real value of the asset is. And last assets in this non-current side, this non-current part, are financial assets. This represents those investments made by the company. When the company has a high monetary result, they have extra money, so they have some savings. And they can buy shares from other companies, they can buy mutual funds, or they can buy different financial assets. This way, they get an extra profitability from their savings, from the extra money they have. So these three are the non-current assets: immaterial, equipment, and financial assets. From this point on, what we have is the more liquid part, what we call current assets. First, we have stocks, which represent those things that the company has in a warehouse. We're going to talk about the three most common cases, but there could be more. The first one is the raw material warehouse, for those things that the company needs to produce. They buy from the suppliers, they put them in the warehouse, and they are waiting there until the production department requires them. Then we have what we call semi-finished products. These products are not finished yet. They need to go from one department to another in order to be finished, and in the meantime, they have to be waiting somewhere. So that somewhere, it's a warehouse. So we have the semi-finished product stock. And finally, we have the finished product stock. Those are products that are already finished, that are ready to be sold, but the customers have not purchased them yet. That's why they need to be stocked somewhere until the customers are buying them and they can leave the company. Next asset, more liquid than stocks, are customers. The technical name is customer receivables, and this represents the money that the customers have to pay the company. Do you remember that there was a difference between incomes and collections? When we had the sales, we had sales incomes and sales collections, and sometimes it was not the same. Well, that represents the customer has not paid the company for the product or the service. And this is the place where the company keeps track of that amount. So the customers have to pay this to the company because they bought a product, they bought a service, but they did not pay for them yet. It's quite liquid since next month or in a very short period of time, the company will go to the customer saying, hey, I have an invoice here and you have to pay me. And the customer will have to give that money to the company. So the company will get the cash. And last but not least, the most liquid asset is cash, the money in the bank or the money in the own company. So we have already seen the structure of the balance sheet on one side. Let's go for the other one. Liabilities are organized from less to more enforceability. Enforceability means that someone can come to demand it, to claim it. So the first one in getting money from the company is always the tax office, and this is called the treasury. Treasury is the one that claims first and more often to the company, and that's why we have it on the bottom, is the more enforceable thing. And the last thing that anyone can claim from a company is paid capital. Paid capital represents the money that the owners of the company dedicated to create it. And this paid capital can be claimed in critical situations. For example, if the company is going to be reduced, it's going to be smaller, they want to make it smaller, or in case of bankruptcy, so the company is going to disappear and they use this money to pay their debts. As you can see, liability side is divided in three different parts: net equity, non-current liabilities, and current liabilities. All long-term capitals are in net equity and non-current liabilities. And current liabilities represents those short-term capitals. Let's see one by one each of the concepts in this side. First thing in the net equity is paid capital. This is the money provided by the owners of the company to create it. If the company was created by 3 friends, for example, and each of them provided 1,000 euros, the company was created with 3,000 euros, and this is the amount of the paid capital. Paid capital can be increased in time. 2 years later, or 5 years later, or 10 years later, the company can increase paid capital, asking the owners for more money to grow. Paid capital can also be reduced. But these two things, the increase of the paid capital and the reduce of the paid capital and so on, are things that you will study in accounting courses. So the important thing for us now, in order to do the exercises and understand what we have to understand today, is that you get to know the concept. What is paid capital? What does it represent? That's it. Next thing are savings. Savings can come from the profit and loss account. The company has profits and keeps them, but they also can come from shares. So the company creates new shares to get some money, and these shares can be premium shares. So the company gets an additional money per share and they keep it. This is another name, but for the purposes of what we're going to study, savings is the concept that you need to understand. Next, we have the profit of the year. This is the result of the profit and loss account, and it's also the result of the taxes. This profit is related to what has happened in the asset side. The customer asset, the cash collections, and those stocks we had in a warehouse. And it's also related to the equipment we used to produce and the depreciation that it has suffered. So as you can see, the economic and the financial part of the investment are integrated. One side depends on the other one. And the last concept in the net equipment are grants. And remember, there are two different grants: capital grants and production grants. So these four concepts, paid capital, savings, profits, and grants, are net equity, and nobody can claim them unless the company is in a bankruptcy or similar situation. Then we have the non-current liabilities, that are those long-term capitals that come from outside the company, for example, loans, credits, and so on, and that the company is using them to buy the assets to produce. Under the current liabilities, we have all external funds in the short term. So here we have loans and credits in less than 1 year. We also have the money we have to pay to suppliers because the company bought raw material, but they did not pay for it. Do you remember the difference between payments and expenses? So here is it. And finally, we have the treasury. And the treasury represents the taxes that the company has to pay to the treasury. So this is the structure of a balance sheet, and these are all the concepts that you need to understand in order to understand the next things we will study in the following lessons. Thank you very much, and I hope to see you in the next video.